Joining us on the show today, we have Aditya Narain, who's the Head of Research Institutional Equities at Edelweiss Securities. Aditya, thanks a lot, as always, for joining in. Your thoughts on the week that went by, the week that is likely ahead?
Oh, it's been a tough week, and it's been a little bit of a continuation with what we've seen in the last 1 or 2 weeks. But quite honestly, I don't think it should be such a surprise. The extent of outperformance that India had effectively seen, I think that just meant that you would have some a period of consolidation or a period of the rest of the markets catching up. And so to that extent, I think it's neither been surprising nor has it been dramatic, right? I think what has been interesting within it is that over the last couple of weeks, you've had a couple of bumper listings and you had a couple of most recently very weak listings. And I think at some level, that's a good sign, because what it is telling you is that you have both sides of the market. There is a little bit of a struggle that's going on. And as long as you have that, I don't think the market is going to be necessarily very decisive on either side. And, given that there has been concern that India is probably reasonably overvalued, I think the risk that you see something very dramatic on the downside, I think that just tends to ease a little bit. But, a mix of things, but no big surprise that India has continued to be a little soft.
No big surprise, Aditya. Good evening. But in terms of more softness, which are the sectors do you think will underperform even more from these levels? And which are your bigger bets here?
So, in many senses, what we have got as our overweights, which is where we have comfort given how stocks have performed, is really 3 spaces, right? One is the IT space, which hasn't done particularly well in the last couple of weeks, but we just think the underlying demand is so significant that I think that business support provides you a lot of cushion. The second is the banks, which again, there's part of their appeal is that they have underperformed a lot from a valuation perspective. That's the only segment that's supportive. But most importantly, I think you're beginning to see the start of a little bit of credit growth. You've seen it in the data that came out very recently. Plus, you've got asset quality support there. Amongst these sectors, I think this is where you're tending to see a little bit of a business turn. Quality improving and growth coming and valuations being reasonable. And when you have that mix, I think it's a good place to be positioned, because you can catch the upside and the downsides will tend to be a little protected. And the third space where we are comfortable is really the industrial space. You've seen some movement there. You've seen a good sense of order flow. And I think that's another place where we would tend to find a reasonable amount of comfort. So I think these are the areas where we would really be positioned. Not that they will necessarily move dramatically over the near term on the upside, but the mix between leverage to the upside and protection from the downside, I think this is where it tends to lie.
Right. This week also had a fair amount of listings, and the big listings from the week, we had PB Fintech of Policybazaar and Paytm. While Paytm hit the lower circuit as it listed on Thursday, PB Fintech listed at a premium of 18% earlier this week. Yash Jain joins us with more on these debuts. Yash, a tale of 2 cities.
Well, a tale of 2 listings and pretty divergent reactions from the market as far as both listings are concerned. I'll start with PB Fintech. That listed at the start of the week. The company listed with an 18% premium over its issue price. And so far, on the listing day itself, PB Fintech had crossed that market cap mark of 55,000 crore rupees. It's been 4 days since the listing of PB Fintech. The stock has gained 36% from its issue price. The market cap has crossed about 60,000 crore rupees. Now that the listing is out of the way, what do investors have to look out for? Growth in the offline business of PB Fintech. How does it reduce its advertising spends and continue to maintain the customer traffic? And the third one, that is the recoveries in its another vertical, that is Paisabazaar. Finally, coming down to valuations, PB Fintech on the listing day got a valuation of EV to revenue multiple of 49 times FY21 revenue. That valuation has only increased and become expensive. It's now trading at 68 times FY21 revenue. Coming to Paytm, disastrous debut as far as Paytm is concerned. The stock listed with a 9% discount on the exchanges. Those cuts increased as we moved on with the trading day. At the end of the closing, the stock was lower circuit down. 27% down from its listing price, 20% down from its issue price. Basically, the company has lost 25% of its market cap on the first day itself. The company with its IPO targeted a market cap of about 1.4 lakh crore rupees, ended the day with about 1 lakh crore market cap. Again, coming to the valuations, the company sought valuations of 49.7 times FY21 price to sales. That was the IPO price. But of course, the kind of correction that we saw on the debut, the stock is still trading at about 35.7 times price to sales FY21, which by no means still can be considered cheap.
All right, Yash. In fact, we also had commentary coming in from the Paytm founder, Vijay Shekhar Sharma. This is what he had to say at the listing ceremony.
Today is the day when I believe India raises up to another milestone, when not just the government of India enterprise or a large corporate conglomerate enterprise can proudly say that we could list, we could bring it to stock exchange, and we could build probably one of the largest IPO in the country. Today is the day when that happens, ladies and gentlemen. Today is the day when that happens.
All right, interesting moves on these two stocks. Aditya, let me come across to you now. What do you make of these two stocks? Paytm, Policy Bazaar, tale of two stocks, and generally the new age IPOs. First, let's start with Paytm, because that has been the big talking point for this week.
Well, it's interesting, as I think one of your charts showed earlier, that this has probably been the weakest listing of a large stock in many, many years. I think the takeaway from this is simply that business models need to be clear. Once that is there, then the market can debate the level of growth or the level of profitability. I think with Paytm at this point in time, there isn't enough clarity in terms of how they're going to make their money. And I think that's why there's been this disconnect in terms of the valuation that they came to the market with and what the immediate response is. So I think that's important. I think if you were to compare it with the other businesses, not that they were cheap or each of those was fairly expensive also, but I think there was a very clear sense of what the business is, how it's going to grow, and then the market attributes different growth rates and different levels of profitability. That's why you've seen such stellar performances there with that in terms of the market being ready to pay much more for growth than in the case of Paytm, where I think there isn't enough clarity as yet in terms of how they're going to make money. So I think that's the disconnect. I think there is appetite in the market for businesses that are going to show profits way down the line, but there must be conviction in terms of what it is and how they see it. So it's a very interesting space, right? It's not as if all IPOs are doing well and you just add the word tech market, which is a good thing. And I think at an overall market level, it's not a bad thing that you make a lot of money on some and you lose a little bit of money on other IPOs, because what it does is it keeps the market reasonably rational in terms of what they are going to pay for different businesses. So losing a little bit of money on one stock is not such a bad thing, given that it keeps in check other excesses that might tend to place.
Tech is an old word, Aditya. Tech is an old word. Tells you about the vintage. The new word is platform. Everything is a platform these days. You add platform to that, and maybe you expect the street to give it a bit of a higher multiple. But let's move on, talk about the old economy. We have a Japanese tractor maker, Kubota, that would be investing up to 9,400 crore rupees in Escorts, the agri-equipment manufacturer. Kubota's stake in Escorts will now increase to 53.5% post the deal. Escorts shares zoomed, as you saw on Thursday's chart. As soon as the news hit the screen, the stock was up 10%, continued to build on to those gains, and ended about 11% higher as well. What got the street excited? Sonia Shenoy gets us the latest.
Well, thanks a lot for that. Escorts has hit a fresh record high after its Japanese JV partner Kubota has hiked stake in Escorts. Now remember, Kubota has 9% stake at the moment, and they will be increasing stake via a fresh issuance and will be making an open offer as well. Now the big trigger is the open offer price, which has come in at 2,000 rupees, well above what the street was expecting. And the chairman, Nikhil Nanda, will continue to be chairman and managing director of Escorts. Now, Kubota put out a press release where they said that they expect the tractor market to expand in India. They are very bullish, saying that India is the world's largest tractor market in terms of unit sales. And this investment into Escorts is the best way for Kubota to utilize the combined resources in an effective manner. Kubota will consider developing and manufacturing of basic combine harvesters and construction machineries as well, and Kubota will target India and other emerging markets. Sonia, thank you so much for joining us with all those details. So the current promoter, Nanda Family Holdings, continue to remain unchanged after the transaction. Nikhil Nanda, Chairman and MD of Escorts, told CNBC TV18 they have no intention to dilute their stake in Escorts. We also spoke to Kubota's President and Representative Director, Yuichi Kitao, on their business plans post the deal. Listen in.
There is no intention whatsoever to sell any shares from the Nanda family. We are totally committed. Mr. H.P. Nanda, the founder of Escorts, laid the foundation and the platform of Escorts to serve the nation, to provide farm mechanization products for the larger good. I, as a third generation representative, I'm totally committed to carry that legacy forward. So I would just want to confirm that in this transaction, the family has not sold any shares. We are actually doubling down on the vision of what Kubota and Escorts will build together. And I think with today's transaction, I feel proud that we are going to institutionalize, and Escorts flag will always will stand tall in the domestic market and for the international market.
Escorts will be positioned as an important base of value for mining machinery in India and globally. And also Kubota plans to expand the scope of collaboration from tractors to the entire machinery business, like combined harvester, construction machinery, and the engines.
Well, Aditya, you've heard Sonia, you've heard the managements of both Escorts as well as Kubota. I have a two-part question for you. One, how much of value is now still remaining in Escorts after that 1150 rupee to 1800 rupee move on the share in just the last few months? And secondly, what do you do with the other big player, Mahindra and Mahindra?
So two things. One, we don't track Escorts so closely, so I won't have a very hard view on it, right? But at the same time, your second question in terms of Mahindra and Mahindra, that's a story that I think we tend to like. We also believe that, similar to what Escorts is saying, that not only is the tractor space there to do well, but the farm equipment is a space that actually offers a lot of growth potential. That's an area that's not been adequately pushed in. And I think as agriculture evolves, as the economy evolves, I think that is something that's going to do relatively well. I think the fact that Mahindra is so dominant in that space, if anything, they have only increased their market share. I think it tends to augur well. If anything, it's a validation of what they've been saying over recent years, that that market is in reasonable shape. It still has plenty of legs from a long-term perspective, and there is add-on in terms of the farm equipment, which is likely to grow actually eventually faster than what the core tractor business is doing. So I think if you have a market where you have one large player and a couple of others and foreign investment coming in, I think it sets itself up well. Unlike a lot of others which are growing very, very rapidly and there's a disruptive element, I don't think there's a disruptive element in the broader tractor space. I think franchises are well established, underlying growth rates are reasonable. So we'd be quite comfortable with Mahindra and Mahindra. It is actually one of our top picks.
Take your point. Thanks a lot, Aditya, as always, for joining in and giving us a lowdown on a whole lot of things and a view for the markets as well. With that, we'll step into a short break. On the other side, we'll get technical. We'll speak with Jay Bala of CashTheChaos.com.